So all of us buy cars, right? And we will continue to buy cars throughout our life because that's how we get to work, that's how we drive our kids to school. But the one thing that we've all done is bought cars the wrong way. We bought cars in ways like paying cash for them, financing them, and leasing them, which each of those three options result in your money leaving your family forever, or your money no longer working for you. But what if all we had to do was change one thing and add one step? And if we did that, we could get all the money back for every single car we ever buy, drive, and own. But on top of that, each car we buy, we were building wealth. And what if we could do that without ever having to sell the cars? That's what we're gonna teach in today's video. I'm gonna show you how buying 3 cars will help you build your wealth and how you'll get all the money back for every one of those 3 cars that you ever buy, drive, and own. Hey, thanks for having me on. This is one of my favorite things to talk about. I mean, I love cars, and we were just talking about your new car purchase, which I can't wait to do the video on showing how you're getting all the money back for that Porsche that you just bought. But today I thought we'd go through the life cycle because you never just buy one car, you're always gonna buy cars through your life. So I did this presentation to show how buying 3 cars can help any of your audience build wealth. But not only that, I mean, a lot of people are like, well, how do you buy a car and build wealth? That doesn't make sense. Well, we're gonna first show you how to get all the money back for every car, but then we're gonna show you that each car you buy, you are indeed building wealth, and it does not involve you selling the car at all.
This is going to be super exciting because, like you said, I need this as well. So let's go.
All right, so first thing first, let's just come over here. In order to be your own bank, folks, and in order to get all the money back for every car you're ever gonna buy, drive, and own, you have to understand how banking works. So I always use this, and maybe some of you have seen this, but it's a good refresher. How we've been taught to use money is, in this example, I'm just gonna use somebody making a $100,000 deposit. We put the money into a traditional bank. So we save money, we earn money, and we do nothing but put it into the bank. We all have been taught to do the same thing. And there's a couple of reasons. Number one, the bank is liquid. The bank to us is a perceived safety because of FDIC up to $250,000. But also, some banks actually pay you interest. And in today's interest rate environment, it is not unheard of for somebody to earn 4% on their savings or on their deposits they put in the bank. But here's the thing you must understand. That's what's in it for you. For the bank, when you make a deposit, that creates a liability to the bank. The bank, that is not their money, so it's a liability on the balance sheet. So banks have become experts at turning liabilities into assets, and they do that in a way that all of you are familiar with. They loan that money out. They take the money you put there and they immediately lend it out, which turns it from a liability into an asset. But they don't lend it out at a rate lower than what they're paying you. They lend it out at a rate higher than what they're paying on the deposits. In doing so, they make a spread. So all I'm gonna do is I'm just gonna write the word spread in between here because that's the most important thing. So if you deposited 100 grand in the bank, hypothetically, and the bank lent that $100,000 out for somebody to buy this house. I know that house would cost more than 100 grand, but let's just pretend. They would lend it out at right now, right around 7% interest. The house purchase was sold by the seller that lived or owned the house. So they get the money that was issued by the bank and they do the thing that they've been taught to do. They deposit the money back into the bank account. The bank immediately moves that money back out in the form of a loan. So we're gonna use a car loan because it's just fitting for today. That car right there is a BMW M4. They lend it out at about 8%, which may be a bit high in today's standards, but not out of line. So the car dealership gets the money that was issued by the bank in the car loan, and they put the money back into the bank. The bank lends it back out to somebody doing a home remodel loan. Now, I want you to notice something. The first loan was on this house, a first lien mortgage. So it was a secured investment for the bank or a secured loan. They charge 7%. The car has wheels and can drive around. So if the bank doesn't get their payments, they got to basically take that car back, but now they got to track that thing down. So they charge a little bit more because it's a higher risk loan. Down here in the home remodel loan, that's more than likely a HELOC. So that would be a second position loan. So now the bank's taking on more risk. So they charge right around 9%. And again, the rates vary, so don't get caught up in the numbers. The contractors get the money and put the money back into the bank. The bank immediately turns around and issues that out to somebody for a debt consolidation. Now that's an unsecured loan. So that would be the highest rate. Let's just call it 12%. Credit cards get paid back the money. The credit cards put the money back in the bank. And round we go. This is banking. But now, if we did all the math and we added up the spread between all of these from what you're earning on your deposit to what the bank is charging, what you would do is you would find that the bank made 20% and you made 4%. But that's not the whole story. The bank actually made 5 times more than you did. Because you made 4, the bank made 20. So divide 4 into 20, 5 times, which means the bank actually made 500% more than you did. The only reason I show this is I want to ask you one simple question. What business do you want to be in now? My guess is you're looking at this saying, well, Chris and Christy, I want to be in the banking business because that sounds pretty cool. So that's what we're going to do. We're going to go in the banking business today by you taking back control of your money and by you becoming your own bank. And it's going to only involve you changing one thing and adding one step. And how we're going to do this is we're going to do this by teaching you how to buy cars, because all of us buy cars. But you're going to have to change where your money goes first. That's the one change. You can no longer save money to buy cars in a traditional bank, because the bank is in the business of making the spread. So therefore, you can't make the spread, so you'd never be able to get all the money back for all the cars and build wealth for buying cars if the bank is taking the spread. So hopefully that makes sense, and that's going to basically be where this whole presentation. So I'm going to share my screen here real quick, and we're going to walk through the journey to owning and buying cars. Now what we're going to do is we're going to do 3 different cars. Well, because I just figured why show one when we can show 3? And a little disclaimer, just saying this is just for informational purposes only, okay? These numbers will vary, client to client and, example to example. But down here, this is what I found interesting. When I put this presentation together, I had to find out how are people buying cars? And then it gave me the option to say what generation, what are the differences between generations? Christy, I found this fascinating. When I looked at boomers, Gen X, millennials, and Gen Zs, their buying habits, when you average them out, were very unique. So when we look over here, this is just the average. How do people buy cars? Well, 50% of the folks out there finance their cars through a traditional bank or finance company. Okay, 50%. I thought that was high, but what really surprised me, Christy, and everybody else, is 38% of the cars being purchased are paid for cash. And now listen, I'm a Gen X, okay? And I looked at the millennials and the Gen Zs, and don't take this wrong, but I couldn't believe when you look at this chart, how many of the millennials and especially Gen Zers are paying cash for a car. And then you got leasing and gifting, which were very low, so we're not even going to talk about those too. But let's talk about cash and financing. Both of them have upsides and downsides. If you were to pay cash for a car, you would have to save that money up, which would take you time. But people are clearly doing that. 38% of the people buying cars are saving up cash to buy a car. So think about it this way. Let's say you were saving up and you were using a high yield savings account earning 4% on your money. That's great, because now your money's working for you and earning 4% and compounding on that. But now you save up, let's just call it 30 grand to buy, we're going to buy a Toyota Camry for the first car. You would have to take a withdrawal from that bank account to buy the car. So now when you take the withdrawal from the bank, that 30 grand that you saved up is no longer earning that 4%. It is no longer working for you, and it never will work for you another day in your life, because you took the money out of the bank and you bought a car. Now, let me ask all of you a question. Do cars go up in value or down in value? Now, I know there's exceptions, but for the majority of the cars we will ever buy, they go down. They are a depreciating asset. So you bought a car that now will be worth less in the future. Again, you lost the earning potential on all the cash you paid for the car. I hate when people pay cash for cars if they do it the traditional way. Financing also has a downside. When you finance a car, you're making monthly payments of principal and interest. And who does the interest go to? Somebody else. It doesn't go back to you. So now you're losing the earning potential on the interest, and that interest is leaving your family forever, and you're buying a depreciating car that certainly will be worth less than you paid for it. So now take that fundamental of how we buy cars, and now let's go down and let's do some scenarios here. If you were to save and then spend the money to buy a car, here's what it looks like. Every single time. We save, 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 and then we buy the car, and we have nothing. Save, 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 then we buy the car. So it always ends in zero, which is a losing proposition for building wealth. Okay, the second way we would do this is we would borrow, finance. Okay, so what we do is we borrow, so we're in the hole, and we pay, 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 and then we borrow again to buy another car. Because listen, like what happens when you buy a car? By the time the car is paid off, for some miraculous reason, everything in the car breaks down. True or true? You take it to the dealership, you're almost done paying, you're so excited. Literally, you're a payment away from having this car paid off. And you bring it in, just get an oil change, but then all of a sudden, the service team comes out and says, ooh, Mr. or Mrs. Car Owner, I'm so sorry to bring you this news, but we did a thorough inspection of the car. We just like to do that for our clients. And we found that your brakes are completely shot. This car is not even suitable to be driving. You could get in a car accident. And you're sitting there going, oh my gosh. But not only that, you got a little bit of an oil leak. And miraculously, at this present point in time, your car is now out of warranty. It's funny how that works. You got an oil leak, your brakes are shot, oh, and your tires will not pass an inspection. It's kind of funny how this works. So what are you doing? Well, you're out in the lot and you're saying, well, maybe I'll just get a new car. And they got this great deal on this new car. And what do? You just trade in the old car. They give you hardly anything for it. You get the new car and you restart the cycle. I elaborated that a little bit, but is that not pretty close to what we do? It is. And it always ends at zero. Another losing proposition for building wealth. But then there is the way that you've never been taught how to buy cars, which I'm going to show you today, which is you becoming the bank and you taking back control of your money. Here's what it looks like. You save money, okay, but you never lose the earning potential on all the money you saved. In other words, when you buy the car, you don't use your money. Your money continues to work for you, which results in continuous growth. Now, although we are going to take loans, but we're going to take loans from our bank. So then when we're paying interest back, and then we're taking another loan and doing interest, this is just a combination of the other ones, except this results in your money always working for you and always growing. So this is the fundamental of how we want to buy cars. So to do that, I always thought, how many cars does somebody buy in a lifetime? And I found this interesting when we looked at this. The average American buys 8 to 10 cars in their life. So I said, okay, 8 to 10 cars. How much wealth could we build by buying 8 to 10 cars? Well, we're only going to do 3 today, but I thought it was interesting, and someday I'll do that where we buy 8. But here are the 3 vehicles we're going to buy today. And all I did is I took what you could pay or what you could buy a car for today. So these prices are all just based on today's numbers. When this video is a year, 2, 3 years old, these numbers will make no sense, okay? But I just want you to know this is based on what you could do today. You could buy a Toyota Camry for right around 30 grand. It would cost you $585 a month at 6.39, which is a pretty good rate, okay? And that would be a 5-year loan. So you'd pay $35,126 total to buy that Camry, which means $51,226 of that is interest. But once you're done with the Camry, let's upgrade. I do these car examples, but I always show the same car, and that's just no fun. We're gonna go from a Camry and we're gonna buy a Model 3 Tesla. That's gonna cost you about 50 grand, which is gonna result in a $976 monthly payment, totaling $58,550 or $544 if you were to finance the car, and that's $8,544 gone to somebody else's bank. And we're going to finish this whole thing up with this 2025 Ford Raptor R. Pretty awesome truck. Now, I live in Buffalo, New York, and we are literally in a deep freeze and a major snowstorm, so I am dressed for the weather today. But if I was really to get ready for the weather, I'd probably get me one of these Ford Raptors, because that's a pretty cool car to be driving around in the snow. But they come at a big price of $85,000. 60 monthly payments of $1,659. Total payments, $99,525, almost a $100,000 vehicle when you're done with financing. And you lost $14,525. Now, that's how it would be if you financed all these cars with someone else's bank. I'm going to walk through, but if you changed one thing, and that is where your money goes first. And we're not going to put the money in a bank. We're going to put the money in a specially designed and engineered whole life insurance policy where we are able to save and spend at the same time while building wealth and continuously growing our assets. Now, these are just the tools we use. So today we're going to use a gains projector, which is going to show us, we're going to use a major purchase planner, which is going to show us buying vehicles, but we could also use these tools to pay down debt, to invest in things like markets or real estate, whatever. And come down here and I'm going to show you what this looks like. So what we're going to do again, we're going to save up money. Now, many of you probably already have money saved up because you're ready to buy a car. So we're going to assume that somebody has saved up $34,000 because they wanted to buy a new car, okay? And all we're going to do is we're going to change where that $34,000 goes first. But we're not going to just put it in a regular whole life. We're going to design and engineer a special whole life insurance contract that is going to have high early cash value that can be used immediately in the first 30 days. So we're not going to have to wait. And this is just showing you how we design it. Now, I'm not going to walk you through all this. I'm just going to show you the numbers because that's really all people care about. So we're going to save up that $34,000, okay? Most people already have this money sitting in a bank account, and we're just going to change where it goes. We're going to take it out of the bank, and we're going to put it into this specially designed whole life. Then what we're going to do is we're going to continue saving because every 5 years we're going to buy another car, and because you're already probably saving, we're going to continue saving. In this example, we're going to save $6,000 per year. So here's how it looks, okay? And I want to get specific about this because this is really important that you understand this. The first year in doing this to buy cars, we will have put $40,000 into this policy, of which right immediately in the first 30 days, see this guaranteed cash value? Because our 40 grand that we put in there is going to earn guaranteed interest plus dividends, and it's going to grow tax-free because that's how we design them. We design them properly within the IRS rules. So we have $36,000, give or take a buck or two, immediately in the first 30 days. But after the first year, the insurance company is going to pay us a dividend. That's going to show the dividend column right here. Okay, so now we have $36,000 after the first year. But we only need $30,000 to buy the first car. But I just want to show you what this will look like as years go by. The first year is going to look terrible. And you already probably figured that out. Wait, Chris, we put 40 in and we only have 36,000 we can use. I get it. You only have 92.03% of the money you put in. That seems like a terrible place to put your money. However, if you have a family or little ones like me and Christy do, well, Christy's aren't so little anymore, but I have a little 4.5-year-old, and I know if I happen to get hit by a car tomorrow or have a tragic accident and I go on to heaven, I want to make sure that my family's in a better place. And I'm willing to put up a little bit of money to make sure that they're going to have money when I'm gone. So that would be a death benefit. This policy here, okay, it has a death benefit of $1.369 million. So where did that 8% that we didn't have in cash value go? Well, it went to pay for the death benefit, of course. So I do want to make sure you all understand there is a cost to do it this way. But that cost is outweighed in the near future, and that near future in this one is year 2. Because the second year, when we save $6,000, we're going to have $5,080, which is 84% of that money available. And then the third year, when we put that money in, we're going to have $6,000, and you're going to have 96% of that money, but by the fourth year, you're going to have $114,000. Now, me and Christy were talking about this, and I want to call this out right here. Me and Christy were talking about how her policy is efficient in the second year. But I intentionally wanted to show you this policy design because this is not the most optimum policy design for what we're talking about. Because you can see here, it took us 4 years to get efficient. So I did this intentionally, folks, because I wanted to show you that no matter what, even if your policy wasn't designed properly, it's the process called the infinite banking concept that's going to matter. But now what I'm going to do is I'm going to go in, as I'm going to show you, I'm going to stop sharing this for just a second, and I'm going to quickly show you something that should really, well, I think all of you are going to really like this. All right, so now what I'm going to do is I'm going to show you a properly designed policy for buying cars. And all we did is we took the same exact scenario we had a second ago, but now what we did is we designed it for higher efficiency in the early years. Same numbers, everything's the same as what we just looked at, but now we put 40 in, and we're going to have 37,000, which is 93%, a little bit better than the other one, but look here. The second year we put 6,000 in, now we're taking $6,617. And then the third year, taking 7,000 out. So the first or the second year, this is going to kind of be like what Christy was asking me about. She says, hey, my policy is efficient in the second year. Not all policies, because everybody's different. It could be health related, it could be medical situations that make somebody get a different rating. But I just wanted to show you that both examples will do the same thing when applied to the infinite banking concept. But we're going to use this policy design because this one is more appropriate because everybody loves these numbers. Now, when we buy the car, like I mentioned earlier, what we're actually going to do is we're going to take a loan from the insurance company. So let's just say we're going to buy a $30,000 car. I'm going to show this in a second. Okay, we're going to take $30,000 out of the policy. Now, if we did this in a bank, if you started with $35,936 in a bank and you took $30,000 out to buy a car, how much money's left? Well, there'd be $5,936 left, right? If we do this with this policy, because it's designed this way, we still have $35,936 earning interest at a guaranteed rate plus dividends, even though we took the 30 grand out to buy the car. Now, the only downside to this is the insurance company does charge us interest on the loan. And the interest on the loan is roughly, in this particular insurance company, 5.24%, okay? 5.24%. But what I didn't tell you is how much this insurance company pays you on your $35,936. This company pays you guaranteed interest of 3.25, plus they pay a dividend, which gets you up to 5.75% interest and dividends. So this is what we're earning, okay? This is what we're paying. Remember the bank example where I showed you here's what the bank pays you 4, here's what the bank charges you 7, the bank's making a spread. We're doing the same thing. And even when we do this, in the early years, the only year we lose money is the first year, but that first year, see, here's the difference. I hope you all picked up on that. The first year, I have a death benefit of $765. Remember, the old one was $1.3 million, but I had less cash value. Do you see the trade-off? In order for us to get higher efficiency out of these policies, we have to reduce the death benefit. So the client has to decide what's more important, cash value or death benefit. You're always going to have both, but we can pick and choose which one we adjust based on the client's needs. So here we gave up death benefit, but we got a lot more cash value. Hopefully that makes sense. Now what I want to do is I want to move on to the super fun stuff, and that is let's buy some cars. So the very first car we're going to buy is this car right here, the Toyota Camry. Again, remember, if we were to have financed this Toyota Camry, we would have given away about a little $5,800 if I'm not mistaken. But here, we changed how we're going to buy it. We put $34,000 into the policy right up front. We saved $6,000 throughout the course of the year. We immediately take the loan for the car in the first 30 days that we put that deposit in, and we bought this Toyota Camry for $30,000. But we still have all the money in the policy earning interest and dividends. Then what we're going to do is we're going to set up a monthly payment for the exact same amount you would have paid the traditional bank. Now, when we do the video for Christy's new vehicle, the cool part is Christy, when she bought this new Porsche, she financed it because she negotiated with the finance company at the car dealership, and she got the best rate. So then when she then takes the money from her banking system and pays that loan off, she's going to repay her bank the same exact monthly payment she pays their bank. So we're doing the same thing. If we were willing, and more than, 58% of you were paying a monthly payment of $585, so we're just going to pay the same amount you would pay the bank, and we're going to pay that back to our policy. Now, this does something unique. Remember, if I said you're earning $575 on the policy, but you're paying 5.24%, the spread would be the amount in between. And every year when I gave that example, the spread goes up, because your money's always compounding. But here's the other cool thing that I didn't mention. Because we're paying $585 back to the policy, every single car payment that you make of $585, you now have $585 available to use the next day, because you're making payments back to your bank, not their bank. There's no way you ever buy a car and make a car payment on that car to a traditional bank. There's no way they'd give you that $585 back. That's their money. They keep that. That's never coming back to your family. But because you are the bank here, this $585 is coming back to you. Every single month, that money is being recaptured in your banking system, which is the policy. All the while, we are reducing the loan that we took from the insurance company. Because essentially all the insurance company did is said, hey, we'll give you part of your death benefit while you're living in the tune of 30 grand, as long as you have at least $30,000 in cash value within the policy, which again, we do because we deposited the money in the account. So therefore we have that money earning, and that is what the collateral is. So now that we got through the hard part about the process that we're gonna go through, we're gonna do this over and over, and I'm gonna show you the math on each car we buy. So this is the loan. $30,000 is what we took from the insurance company. Here's the interest we paid on the loan. See how it goes down every single year? Remember, we're making $585 monthly payments back to the policy, but we're recapturing that money in our policy, repaying the loan to the insurance company. So every year we pay less interest to the insurance company. All the while, our cash value, look at what it does, keeps going up and up and up at a higher velocity every year. And that's what compounding is. So what is the net result? Well, at 60 months in, we have bought this Toyota Camry. Our cash value in our policy is $66,121. Okay, our death benefit is $826,080, and our premiums that we put into the policy are $64,000. So we put $64 in, but we have $66,000 available after buying the first car. But over here, let's just do the loan, because remember, we had to pay for the car, and the insurance company did charge us interest. So the total loan payments were $35,100, the same amount you would have paid to the finance company, and we made an overpayment of $1,538. This is confusing. It's just the way the math works. We had to pay extra $1,538 into the policy because of that last payment. So down here, here's the benefit. We paid $66,121. Or I'm sorry, we have $66,121 in cash value available to be used. We have a car that is bought and paid for in the driveway. So this Camry, which we paid 30 grand, so I'm going to call that 30. Now I know some of you are like, wait, that car's not worth 30 anymore. I get it, so I'm just calling it at face value. Even if the car was worth half of that, that money is still there and available, because remember, we're not selling the car. The car's just in the driveway, bought and paid for, plus the overpayment. So here's your benefit, $97,659. The out-of-pocket money that you had to capitalize your banking system is you put $64,000 in right here, that premium plus your dump in, plus we paid $35,100 for the car. So when we look at these, you put in $99,100 to buy the first car, but you got $97,659 of it back. So you got 98 cents of every dollar back for the first car that you bought. It's not 100%, but please, if any of you can tell me how you get 98% of every dollar back for the car that you buy now without selling the car, then you can teach me how to do this. Plus, we got a nice death benefit for our family. But let's keep going, because now we're going to buy another car. We're going to buy a Tesla Model 3. Now, because now this is your second car, we're only putting $6,000 per year into the policy. We take $50,000 out to buy the Tesla. We do the same thing we did before. We take the same payment and the same interest rate that the bank was charging us, and we just put that money back into the policy. Remember, just like the bank, when I went around the circle, we're just doing the same thing. Money is going into our banking system, which is the policy. Money is leaving our banking system, buying assets, which is the car. Payments that we would have normally given away to a traditional bank are coming back. So we are creating the same circle I started with. So we are doing the same exact thing a traditional bank does with the deposits we leave there, except for we're doing it with our own banking system. Now let's kind of go through and let's look at what all this looks like. So we're going to come down here. Here's your loans for the first two cars, the Camry and now the Tesla. Again, you can see the declining interest because we're always recapturing that payment back to the policy. You can see the increasing cash value. And now after the second car, we have $112,852 available. So here's the math. The cash value in your policy is $112,000 and change. The total death benefit is now $302,199. Some of you are thinking, whoa, 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 whoa. How do we go from $800,000 to $300,000? A part of that death benefit was a term insurance rider that was put on the policy for 8 years. We no longer need that term insurance rider to satisfy the IRS requirements, so we dropped it. We got rid of the expense, but the net result is we have a lower death benefit. Again, optional for everybody. They don't have to drop the term rider, but the reason I do is I don't want the expense in the policy. I'm doing this to build wealth, not for a big old death benefit. So that's That's why the death benefit's lower, and you'll see that on the next car. The premiums plus the dump in are $92,000. So we put $92,770 in, and we have $112,852 in cash value. But over here, we took loans of $93,660, and we've made overpayments on these cars of $4,171. So when we come down and look at the benefits, that's our cash value, 112. That's the 2 cars we bought, 80,000, and here's the overpayments we had to make. So we've got a true benefit of 197,023, where our out-of-pocket expenses were the premiums that we put into the policy plus the dump in, the cost for the cars plus interest, so that's 186,430. So now on this second car, this Tesla 3, we've gotten 105% of every dollar back for the cars, okay? We have a death benefit of 102,199, but wait, we now have 2 bought and paid for cars sitting in the driveway, which you could do anything you wanted with. You could have traded them in on the next car, which would have helped. You could have sold them, which would have helped even more because you'd get more than trading it in, or you could donate them to a charitable cause, which is, you know, a really good thing to do. And if you know you're getting all the money back, maybe giving the car for charity is an option now where, you know, for most people, they can't do that. We're going to wrap this thing up with a final vehicle, and that is that 2025 Ford Raptor R. Now, there's one thing that I couldn't do because I can't predict the future, is I couldn't go in and say, how much would a Ford Raptor R cost in 15 years? So I just used present value. I just wanted to call that out because some of you are thinking, wait a second, this is the 3rd car. You know, 10 years has elapsed up to the purchase of this vehicle. There's no way you could buy a Ford Raptor R for $85,000 in 10 years from now. It doesn't matter. We have over $112,000 in cash value. So we could buy a car right up to the total amount of cash value you have, 112. So as long as this Ford Raptor R doesn't cost $112,000 or more, we could have bought it. But we're just going to use the $85,000. So again, same exact thing we did before. We're going to make monthly payments of $1,659 back to the policy. I want to remind all of you that every payment you make, the $1,659 or any of the payments you saw that you're making, that money is available to you the next day. You are not making a payment that is gone like most of you are used to when you lease or finance a car. You're the bank. And if you make a payment to your bank, that money is in your bank. The only thing you're losing is the interest on the loan you took, which is the $85,000, which now will go to that screen where I show the interest you're paying on that loan. And also the cool part is the insurance company is charging you less interest than the bank is. Okay? Insurance companies typically have a much lower interest rate to borrow money from your policy than traditional banks do because it's a zero-risk loan from the insurance company. Your cash value collateralizes the loan, and they're just giving you your death benefit up front before you pass away. So here is the loan interest you paid. Again, every car, you're declining that. So you're paying less and less interest to the insurance company. You're keeping more and more money and building more and more wealth. So now at the end of this one, your 3rd car, you have $152,802. Let's look at the sum up at month 120. You've bought 3 cars, a Camry, a Tesla, and a Ford Raptor. You now have $152,802 in cash value to go buy your next car or do whatever you want with it. Okay, you have a death benefit of $358,200. Notice how it's going up. And death benefits will always go up with the way we design these. Initially, we started with a high one. We dropped the term, and now we're rebuilding that death benefit. I'll go back and show you the schedule in a second. We put $102,370 in premiums plus the dump in. So we put 102 in. We have $152,802 in cash value. Not too bad. We bought 3 cars totaling $193,200. That includes the interest because that's the loan payments. And we made loan overpayments of $8,632. So when we look at the true benefit of buying 3 cars, that's your cash value. That's the amount of cars you bought. That's the overpayments. That's $326,434 benefit to you for buying cars. Out of pocket, you have $102,000 in premiums plus $193,200 in buying cars. You put out $295,570 to have a benefit of $326,434. There is no way the average person would ever know how to build wealth by buying cars. Cars are a wealth destroyer, not a wealth improver. So you got 110% of every dollar back by this 3rd car. And that's the average. So literally, for every dollar you paid for a car, Now at the end of this third car, you got $1.10 back for every car. Oh, but wait, remember, all three of those vehicles are in your driveway, bought and paid for, and they all have value, which I accounted for. And you got a death benefit of $358. Now I'm just going to go back, and now that we did the cars, I just want to kind of go back to the schedule of that policy design, because this is an important part where people want to see this. This right here is your projected cash on cash return. So this is how much your money's growing year over year, and here's your death benefit, like we talked. Remember where your death benefit dropped is where we got rid of this term insurance for $594. We dropped it. But see how the death benefit starts going up, up, up? And if I kept going further with the schedule, this death benefit would keep climbing. But also with your death benefit going up, so is your cash value. Here's your cash value. So that's what you accumulated in cash value. And here's the return you made year over year. So you made 10.28 the second year, 16.68 the third year, 23.45 the fourth year. So all I'm accounting for is every new dollar we put in, that's what we're making on the new money going in. Because each year, I'm basically accounting that we're taking that money out and buying a car with it. So that money's gone. It's already in the car, but we're still earning interest on it, which is why you can have these kind of returns on your cash value. So hopefully this was helpful for all of you. Hopefully you now look at buying cars a completely different way than you did prior to watching this. And your scenario will be different than what I showed, but I am more than happy to do a scenario for each and every single one of you. But most importantly and first, we're going to show Christy how to get all the money back for every Porsche she ever buys, drives, and owns.
Wow, that was a lot of information. My head is smoking. That's a lot of brain work. But I think what I really took away from that is you did a one-time dump in. This wasn't a continual $40,000 a year you were putting in.
Nope.
That is mind-boggling that you can put in a one-time dump and watch that unfold like you just did.
The other cool thing is look, in life, a lot of times, like our finances change. So this is the schedule we did for this particular example. But at any point in time after the first year, this client, if they couldn't save $6,000, their minimum was $1,920. So that's the minimum, and this is the max they could save. So that's a really important thing that I didn't cover there, is there's flexibility built into the savings plan for each client.
Amazing. Still, I mean, so you're talking about doing a one-time dump in. You're just putting basically, when you're talking about the premium, are you talking about where you're making your payments back to you? Is that?
In addition to that, so the premium, that $6,000 that I was talking about, that's new money you're saving each year. It's just money that you were normally saving in a bank account for the next car purchase. So that $6,000 is your savings. The car payments that we're recycling and recapturing are just the payments that you used to give away that now you're keeping. You're just putting them back into the policy as a loan repayment.
That is insane. Oh my gosh, I am so excited to see what you do with my own personal purchase, because I have a 14-year-old that's going to be needing a car, in a couple of years. And to think that I'll be able to have this one completely paid back into my policy, probably, and be able to pull her a car out of that as well, that's amazing. Wow. Thank you so much for sharing that.
You're welcome.
I was going to say last night during a live stream, I had somebody jump up and they were talking. We had brought up your name, Chris Naugle, and they said, "Yeah, that whole life policy stuff is a scam." And I said, literally, what the banks are doing is a scam. That's the scam, but we're brainwashed to believe that that's the right way to do things. And I think that if my channel could just show any person out there anything, is just take a step back and compare. Look at what's actually happening with your mortgages, with your car loans, and then compare, using a strategy such as what you showed us against that, and see, what is the scam. And I think that's the hardest thing to get across to people. And I'm going to keep working on that because if I can just get people to change their mindset, like you said, where the savings is not going into a bank, it's going into your own bank, I swear we'll change the world because so many people are broke just because they're paying all of that interest out to these loans. It's unbelievable.
I love that you said that because in how you said it, you're like, banks are the scam. 100%. You know, when I look at the earnings reports, you know, at year end, and I look at the fact all the banks, all the big, you know, national banks that we know of that are in every corner, they're all showing record profits. And they're all saying that they're earning record profits because of interest income. But yet everybody, you know, the public just sits there and is like, oh, wow, banks are doing good. They're doing good at your expense. Think about that for a second. The Fed raised rates. You're paying higher interest on everything you finance through the banks, and the banks are laughing about how much more money they're making. You're the reason they're making more money because you're giving up all of your money to the banks. By showing you what I just did, all you're doing, literally, all you're doing is taking back the banking function in your life. You're literally just not using the banks, and you're doing the same thing the banks did to you all these years, but you're doing it now, creating your own banking system. So when people tell me, oh, that banking thing is a scam, that whole life thing is a scam. So first off, I would say, oh, the infinite banking concept is a scam. That's funny. Then that means all banking throughout time has been a scam, but yet you participated in your whole life. Secondarily, you say that the whole life is a scam. Whole life's been around longer than any of us. It's been around hundreds of years, and this concept has been used by all the wealthiest families in history. So by saying that the policy is a scam, you're literally telling all the wealthiest people that they don't know what they're doing, and their advisors and their family offices don't know what they're doing. But you're also saying to people like Albert Einstein that compounding interest is a scam. So you're literally saying that mathematics as a whole is just one giant scam. Because everything we just showed, although it was a lot of numbers and a lot of input, that's all just mathematics. It's all we were doing is math the entire time, which is why your head's probably ready to explode. And we'll bring this and make this really simple because the next one we do is just one car with Christy's car. But I wanted to show three because that's the life cycle of most people's lives. You don't just buy one, you buy multiple cars.
Right. You're right. That's exactly right. It was a great rundown of how that would look. But you know what? The banks own the biggest buildings in your city. And I was looking, we had a new bank go up. My husband and I were on the interstate the other day, and there was this big, huge new bank. I've never heard of it before. And I said, wow, look at that building. Never heard of them. I know people locally aren't using them yet, but they came in and built this huge building and with our money. They did it with our money.
I got one real quick. This will blow your mind too, and everybody can go on and do a Google search. Almost every building that you see like that, the giant bank buildings, the bank doesn't own those buildings. They are financed with loans from giant mutually owned insurance companies. Look it up. It's fact.
Wow. My goodness. It's angering, is what it is. And there is one going into a small city. Really, I live in the one of the poorest states in the United States, and I live next door to one of the poorest counties in the United States. And it's like these banks are hilarious. And this one has a sign on a billboard as you're going into that very small city. It says, come see us. We're your friend. And I was like, holy, I told my husband, I said, that is the highest interest rate I've seen on a mortgage so far that came from that bank, 8.65% for
Wow.
a mortgage. And we're your friend. So people, we got to wake up because this is uh amazing information. If you take a minute just to sit and watch what he has laid out for you, so very simple, very elementary. It's a lot of information because there's a lot involved with what's going on, and he is literally breaking it down and showing you what a bank is actually doing with your money when you're just taking it and sitting it in the savings account first off, and then they're turning around and loaning your money out to other people. So just imagine whatever amount of money you have sitting in your checking and savings right now, they have loaned it out probably about what, nine times? I mean, or is it
I
900?
know. 900 times probably.
It's crazy. So I just appreciate you taking the time to come on here and show us this because I am aimed and determined to get this information out there to the people as long as the banks will let me stand doing it, because it is something that people need to understand, that you are in control of your money if you'll stand up and take control. That's the problem. Is people are so like into the system and they're just rolling with the flow. And sometimes you've got to stand up for yourself and say, wait a minute, I'm going to take control of my money. I'm going to get set up in the strategy that's going to serve me for once. So wonderful, wonderful information, Chris. Thank you so much. I can't wait till we get more videos out to the people so that they can be educated. We're just not educated. So thank you again.
My pleasure. And the final thing I want to say is, when you look at Social Security, the statistics behind retirement, only 5 out of 100 people will be financially secure at the age of the retirement. And I think it goes right into what you just said. Why? Why are only 5 people financially secure and the other 95% are not? And you summed it up. Because the 95% conform to what they've been told, and they've been doing the same thing over and over again their whole lives. Listening to somebody else tell them what to do, listening to be told how to act, how to invest their money, what to do with their money. And if you really just understand, and we should have learned a lot over the last 4 years about what really is going on out there, it benefits them, not us. The 5%, all they did different is created. And that's what we're doing. We're teaching creation. We're creating our own financial legacies and our own financial destinies, and that's the difference. Hey, if you like this video, check this one out to show you how to get all the money back for every dream car you ever buy.